afternoon, everybody. Welcome to this event, to this showcase where we will discuss about the Acceleration Fund and the investment EV opportunity set by the Africa Infrastructure Investment Manager. Before moving to the topic, I would like first of all to remind some housekeeping rules. The recording and deck will be shared after the presentation, and we advise you to use the chats for networking and the Q&A for questions. Right, now I will introduce our speaker of the day. We have Zoë Pierre, who is the investment manager at the Africa Infrastructure Investment Manager. She has 10 years of experience in energy and infrastructure investment across multiple sector and geography. She has previously worked at Macquarie Asset Management. She's passionate about energy transition and infrastructure development in Africa. So here she will really present this topic with a lot of passion. And also she had a BSc in geophysics from the Imperial College London and an MSc MA in energy trade and finance with distinction from Bayes Business School. Zoe, you really made some investigation to learn more about you and also to let the participants really about who you are and what they should expect. Now I will hand over the presentation to you. You can share your screen and
Excellent.
Yeah.
All right, you said share, you don't see it now?
Can you share your screen on your side?
I thought I was. Hold on a second and I'll do it again.
Okay, try it again.
There we go. Now we should
Perfect.
be. Okay, great. Thanks. Thanks, Salim, and hi, everyone. Thanks for taking the time, well, choosing to spend some time with me. And let's just jump right in. So I've had that intro, so we go through to what we're doing here today. So what I want to address and hopefully get through this in just 30 minutes is to first explain the real bottleneck in Africa's energy transition, then to talk about how ATAF is designed to solve for that, and then finally to spend some time, or most of our time rather, on EVs and specifically what is actually investable for infrastructure investors. I'll keep my description of this slide brief because for those of you who've attended these before, you'd have seen a version of this from my colleagues, but the context does matter. ATAF sits within AIIM, which is an infrastructure investor with over 25 years experience in Africa. We manage almost 4 billion in assets and have deployed about 1 billion of that into energy transition sectors. We operate across 5 offices with locally based teams. And most importantly, we're an execution-focused house. We have that proven ability to originate and deliver infrastructure investments in complex African markets. And ATAF is a natural extension of that capability, but doing so in an earlier part of the infrastructure business cycle. What this really shows is that Africa's energy transition opportunity is large, and the reckoning of that, alongside the fact that not enough capital was reaching those projects, is why ATAF was created. To meet 2030 climate goals across the continent, energy transition finance has to increase by around 4 times. And I want you to kind of let that number sink in. We're talking on the magnitude of several billions USD equivalent dollars needed if each individual country's targets are to be met. But today, less than 10% of infrastructure projects reach financial close. Only 7% of that financing is equity, and only 14% of private capital, of that is private capital, which is a real understatement versus what we see in developed markets. So what we've learned is this: Africa's so placed to transition is not a demand problem. The projects are there, the need is there. It's not a technology problem. Those technologies have been deployed at scale in many places, but it's a capital formation problem. There's a valley of death for these from early stage development to financial close. And it's not because projects lack in viability, but rather they're failing because they cannot access early stage capital. So ATAF was created to address that exact gap. We are a $200 million fund, blended finance vehicle, and we're targeting exclusively early stage energy transition infrastructure. A real mouthful, but early stage green climate is probably the easier way to say it. And this chart really just shows that we sit between what would typically be venture capital, and that's the bottom left of the graph, and traditional infra in the upper right, which on the continent has had a preference for later stage developed assets. I should point here that there is some of what AIIM has done in the past, which if on a looking back basis were done today, would probably fit within the ATAF mandate. But we are exclusively mandated for this to target this part of the value chain almost. So we're looking to support those opportunities which are too early for traditional infra and too capital intensive for VC investors. The way we've structured the fund is responsive to private capital's prior hesitation to invest in early stage opportunities. So 25% of the fund is first loss capital. And what that means is that that piece absorbs the early stage risk and so acts to attract the upper part of the senior capital, which makes up 75% of the fund structure. I haven't put the names of the investors here, but it's publicly notable. So it's an ACP and FSDA, which really are a bit more impact aligned than the 75% bucket of investors. On top of this blended structure, the mandate is built around 3 core objectives. The first is climate impact, investing in real assets that reduce carbon emissions or build resilience. And then you see that it has to intersect with the acceleration, which could be thought of as catalytic or a catalytic behavior. And here is really, again, repeating that point that we're targeting the key bottleneck in Africa, which is early stage capital and unlocking larger follow-on investment by proving out those business models. And then thirdly, we're built around the objective of getting returns. So this is a fully commercial strategy. And I say that this pillar is probably a differentiator from some of the other blended finance vehicles that exist in the market, which can be more impact driven. In those structures, junior capital subsidize seniors' returns, but that's not the ATAF structure. And so put simply, if any of our pipeline businesses, any of the businesses that we assess aren't commercial, we won't invest. It has to hit all 3 of these things, not one being very good and we could do it because even if the other 2 don't hit. So ATAF sits at this intersection: impact, acceleration, and returns. Our focus then is on, I've said many times, early stage energy infrastructure. And I kind of underscore that point because when we launched the fund, we were inundated with inbounds on everything climate and early stage. But really, we are focused on asset-heavy, scalable platforms that can deliver both impact and returns. And that asset-heavy point, you can see in this graph, just to pick it out, we want core. It's infrastructure core is what we're interested in. We invest across that in 3 verticals: clean electrons, clean molecules, and sustainable transport. And you see those color-coded on the chart. Of those 3 areas, though, because I won't go into too many of them, let's zoom into sustainable transport, which is our fancy way of saying e-mobility, because it's a compelling opportunity set. So e-mobility globally is scaling, and this is driven primarily by technology, economics, and policy. But the key shift is this. So batteries used to be very expensive with limited range and too heavy to place in vehicles. So they were just clunky and not very good looking as a car, right? But that's just no longer the case. The constraint to EV investing or EV expansion is no longer technology. It's rather how to build bankable business models around this technology that is now proven to work. Battery costs have fallen by over 80% since 2014, which means EVs are much cheaper to buy than they used to be. And because of that, the point where EVs become cheaper overall, what we refer to as the total cost of ownership, now happens much earlier especially for vehicles that are used a lot. So I don't know if you've caught the point I'm making there, but the upfront cost used to be the barrier to entry. That's materially fallen. The sale has always been that the running cost of an EV is cheaper than an ICE vehicle. That has stayed the same, but because the upfront cost is lower, the point where those two things, that total cost converges, is much sooner now for EVs, in the EV mileage case. So in many commercial use cases, EVs are already cheaper to run than diesel vehicles because where they have that high mileage usage. And that's simply because electric vehicles are much more energy efficient. So you get more kilometers out of electricity than you do from fuel. So the internal combustion engines are incredibly bad at converting that stored energy in oil into movement. Batteries are much more efficient doing that from power. And that's why the running cost of an EV is cheaper. So we're seeing this play out in real time. Like, we're having fuel price shocks now, which we expect to get worse with the war that's happening. This is the kind of theme that we expect the shift to EV will be accelerated. So this transition is not being driven by subsidies as it was in the past or as it was in developed markets at their nascency. It's being driven by economics. And that's a real shift from when EVs first came to market, when adoption depended on that more policy than on cost. Now in Africa, adoption is already happening and it's picking up quickly. There are around 30,000 EVs on the road, but those are mostly two-wheelers and three-wheelers and concentrated in East Africa. There were 200 companies across the continent in different sizes and scales or stages, and the market is growing at around 30% a year. What's different in Africa is what's driving the adoption. So in many cities, transportation is dominated by fleets, or rather by commercial users. So you have large bus systems, minibus systems, motorbikes, or boda-bodas, I used to know them in some markets, delivery vehicles. And so unlike the kind of Western world where you had individual consumers adopting EVs slowly, you have high usage operators in the continent, which can make purely economic decisions and which can leave a route to create a route to scaling at pace because it's big fleets. Once EVs become cheaper to run, which they are now in many cases, because in these high mileage use cases, these fleets can switch quite quickly. So they drive more, they save more on fuel immediately, and that means faster payback for them. And then this continued cycle of continued uptake of the EVs. So adoption scales quickly because it's concentrated in across a number of high usage users. Now, there are still challenges to this adoption. So this projection is kind of make some assumptions on the ecosystem that will continue to persist. Upfront cost is still higher for an EV than it is for an ICE vehicle in most cases. The financing for the end user to access this isn't ruled out in a standardized way yet. Grid reliability is a constraint to charging these vehicles so that they can actually be used. And then there's policies which vary across countries and so therefore have disproportionate impacts on how those models develop in any one region or country. But these are generally trending in a positive way. And that's what's allowing the market to move from this early adoption into scaling. Now, what we're seeing is that EV investment is growing in Africa, but it's not evenly distributed. And it's not always going into infrastructure models. So geographically, capital is very concentrated in East Africa, particularly in Kenya and Rwanda. And they lead with two-wheelers and buses because they have such strong policy support, specifically rebates on assembly in country, a certain EV charging tariff that's lower than the industrial tariff. So they have these structural support features. Behind that, West Africa is emerging, especially Nigeria and Ghana, with ride-hailing and leasing models. And that's really, again, been driven by the fuel shocks that they've had. So the users reacting to prices at the pump just being unsustainably high. Southern Africa is earlier stage, and they're focusing more on industrial and battery value chains. And then North Africa is trying to position itself more as a manufacturing hub than as a demand market. To be seen if that's achieved, but that's the positioning. So it's not one unified market, it's a set of different regional ecosystems. At the same time, and I'm looking now at the pie chart on the right, if you look at where capital is actually going, most of it is flowing into 2- and 3-wheeler companies. Those are typically consumer-facing models where the end user is an individual driver. Now that means you're taking on consumer credit risk and demand risk as an investor in those businesses. So those investments tend to look more like venture capital, focused on growth rather than focused on contracted cash flows, as is the preference for infrastructure investors. So while the market is itself expanding quickly, infrastructure style investment is relatively underrepresented. And that is what's an opportunity for ATAF. That's an extension of the gap. So for each opportunity that comes across our desk, we ask a simple question: is this infrastructure? And this is something we've refined through time because the team, when we joined, was relatively new to this space. And what we mean by that is we're asking, are there long-term contracted cash flows? Or is there a route to that? Would we be investing in really long life assets? How long can these things run? What's the value at the end of the life? Do we have downside protection through ownership and the structure? And can we scale this into a platform with a clear exit path? And for us, that exit path is important because we're a closed-ended fund. And so we want to grow these businesses to then release them into the ether to continue to grow. If these conditions are met, EVs start to look like infrastructure. If they're not, it's much harder for us to underwrite. So we've come to that position because we've seen from more developed EV markets, what we've seen from more developed EV markets is very instructive. Early on, and I'm looking back to developed markets now, a lot of capital went into standalone charging business on this kind of model at build it and they will come. But the key risk there, which was very much realized, is that the key risk was utilization. There should have been a deployment of those assets with an embedded use. So the model has shifted now towards integrated platforms where charging is paired with captive or anchor fleets and contracted demand. That is really important because EV infrastructure only becomes investable from our perspective when we can lock in that usage and revenue from day one. And models where power supply is embedded so that the vehicle's charging and energy are integrated can also be more resilient or add a layer of resiliency. Again, to eradicate that issue of grid reliability that I spoke about earlier. So taking those lessons into Africa, ATAF focuses on fleet management platforms because they give you exactly that, predictable demand, high utilization, and the ability to structure long-term contracted revenues. In contrast, consumer-led models are harder to underwrite. They're more fragmented and they're more competitive and less predictable. And what I mean by that is the differentiation between any two-wheeler is really becoming quite marginal. Each investor will tell you their bike has a higher range designed for the African roads, but from our perspective, there is limited differentiation and that gap is closing quickly. And so you're absolutely reliant on consumer choice. And that, while can be an interesting business model, isn't what our infrastructure-focused model seeks. So for us, fleets are the point where EVs really start to look like infra. I'd stop here and say a comment on as well what we've seen in the developed markets is that first the big players had to let this ecosystem work, act across the entire value chain. So they had to, the Tesla of the world did R&D, manufacturing, assembly, and now offers all the way through to financing. It's kind of after those first players had curated that working ecosystem that you're more seeing a discretization in those markets of players who can profitably perform in either just R&D, just assembly, just manufacturing, etc. And so in the African context, which is at its stage of nascency, we think that the sustainable way to put capital to work is across those integrated models where there's kind of a look through from the assembly through to the financing for the end user. So what does this all sum up to? And actually, I think I've beat my time because I was aiming for 25 and it looks like I'm at 21. But your key takeaway should be a few things. It should be that Africa's energy transition is constrained by early stage capital. ATAF has been designed to unlock that gap. That's one. Secondly, EV adoption is accelerating. It's driven by economics, not subsidies. But not all models are suitable for infrastructure capital. And so ATAF's opportunity is in contracted, asset-heavy platforms that deliver predictable cash flows and scalable infrastructure. Growth alone is not the opportunity. Bankable models are. Okay, so I'll stop there and hopefully we have some questions. I don't know, Salim, if the questions come to you or if I see them in the chat. But hopefully we have some interesting things from the room.
Yes, we don't have question. Yeah, the question will be coming from the Q&A. So here I will start with the first question. The first question from someone who did not mention the name. He's asking that you have highlighted that the main constraint in Africa energy transition is not demand, but early stage capital. So can you explain why so many projects fail to reach financial close despite strong market opportunities?
Yep, exactly. So I'll make it as simple as I can. So some of the opportunities we see, for instance, you have ambitious developers, I shouldn't even say ambitious, appropriately ambitious developers who found an opportunity and have, for the most part, either self-funded or crowd and family funded to get to the stage they are. So they may have an offtake agreement roughly agreed. They might have engaged their equipment providers, etc. And all of those things would have come at a cost to them. But they have limited financial leeway as to how far they can carry those projects. And then on the other side, the big investors who are wanting to invest in infrastructure across the continent want to come in at the point when those contracts are fully baked in, they've been fully agreed, they're just about to sign, banks have indicated that they'll come and lend to the project. And it's sort of not beyond the feasibility studies, the actual route to close has been closed. And maybe I should give context that when I talk about financial close, just in case we have different levels of attendees on the call, I'm talking about that point where all of the contracts are at financial readiness, ready to sign. All of the different financial players, the equity and the debt, are ready to commit to the asset. The gap in time between that early stage, you've done a feasibility report, you've kind of assessed that there's something there to the point of financial close, is something that developers consistently underestimate, and that carries a material cost implication. And the cost coverage for that comes in as development costs. So they are effectively timed out in trying to cover that valley where the development costs are required. And this is where ATAF is really distinct from the other capital that exists in the market, because we're saying we will come in and we will fund that development cost through to the point when your project's assets, platforms become fully investable and ready for that debt capital and commitments of the capital and capex. I hope that answers the question, but it's really a timing out. And I think some of that also, some of the perceived heightened risk of Africa flows into that in terms of why there isn't as much capital playing here. And it's also just the sheer scale of what's needed for the continent to electrify and to electrify really. So it's all those things converging.
Perfect. So Zoe, because you really managed to present in a very short time, so this will give us time to take many questions because we have almost 22 questions, but we'll try to really take as many as possible. So a question from Jerry Okoko. Do you support battery manufacturing?
So going back to that value chain slide, the easy answer is no. But is it a standalone battery manufacturing offer? I guess what I'm trying to make is bring it back to infra. Well, how would a battery manufacturer be differentiating itself as an infrastructure player? I don't have that answer in my head. Happy to be convinced otherwise, but that sits in a manufacturing bucket, which is an investable business model, but isn't an infrastructure model, which is our mandate. So the easy answer is no, but if it was something that was integrated into the parts of a business that then flew through the rest of that value chain through to charging infrastructure ownership and the operations of that, then we could have that discussion.
We have another question.
I have one question, Salim. Is it at all possible to allow users to speak their questions out? It's quite strange talking and not hearing voices. So it's just
what did you say?
Is it possible to have the attendees come off mute and speak, or we don't have that capability?
No. The attendee, they are muted.
Okay, that's fine.
Yeah.
Sorry. I just have a preference for actual live engagement.
So a question from Tukam Ngufanke. Is swapping-based model within scope since you mentioned embed energy models?
Yeah, thanks for that question. So I think as a technology and as a infra, technically, yes. I think where the question gets a bit, and it's still kind of an open question, is the swapping models relate to typically to two-wheeler and three-wheeler vehicles. We have seen it in isolated cases in trucks, but really it's been deployed at scale in the two and three-wheeler market. That market hasn't so far lended itself to a contracted revenue structure because typically it is individual users of the bikes purchasing that bike or finding the financing for the bike and then opting into the swapping model. So that revenue structure is the thing that limits us looking there more than the actual technology being battery swapping. Saying that, there are these large fleet operators. So, you have Uber growing across the continent, Bolt, etc., and the equivalent of that, or the delivery fleets for large supermarkets and retailers. If there is a world where we could engage the corporate entities that own those large fleets and then do something on a contracted basis with them, with the swapping model. So the answer to you is that haven't necessarily seen the structure that allows for it, but as a technology point, theoretically, yes. It's just a question on how the revenue structure behind that business works.
Okay. And another question from Matthews. Could you please elaborate on the challenge of maintenance of EV fleets, notably lack of spare parts and established supply chain on the continent?
Sorry, I think I missed the first part of that question. Could you repeat it a little bit more slowly, please?
Okay. So a question from Matthews. Could you please elaborate on the challenges of maintenance of EV fleets, notably lack of spare parts and established supply chains on the continent?
The challenges of EV fleets, I'm missing one word in the question, but I think you're asking the challenges of operating the EV fleets. Is that right?
Yeah, I think so.
Okay. And to the ask of the question, if that's not right, just let us know it in a message. I wonder where your question is coming from. So there is a lack of manufacturing capacity on the continent. That is correct. But at the same time, that is also correct for the ICE vehicle, right? So right now, what you're competing against, the end user is comparing the choice on EV right now in today's market and the choice of EVs versus the choice of ICE. As the ecosystem matures, we expect that the choice will then become one EV over the other rather than one EV over ICE. But right now, it's an adoption question, and persons deciding, is the running cost of my ICE lower, or is my all-in cost of my ICE lower, is my all-in cost of my EV lower? And so even though the manufacturing capability and including the spare parts, as you mentioned, doesn't necessarily exist at scale on the continent, that's not a limiting factor because those are both imported things, and the imported price of the EV and EV parts are much lower, and the running operational wear and tear on e-vehicles are so much lower than ICE that as a user has a lower requirement for spare parts on a going basis and lower requirements in terms of costs of operational costs. So I don't think it's a limitation yet. I think it's more an opportunity for if manufacturing could be done at a competitively versus China, which is predominantly where all of these things come from, then yeah, there's an opportunity to do it locally and to benefit from some of the policies that are arising around local content creation. But I don't think it's stopping the pace at the moment. It certainly isn't, sorry.
All right. I will take another question. Are you looking to provide equity or debt? And when you say fleet management, are you underwriting a long-term lease with an existing operator who is looking to transition to the fleet or new fleet managers?
Yes. So the second part of the question, that's exactly it. So it's this idea that you have a single corporate entity that we can face, which itself has an existing fleet or looking to create a fleet that it will electrify. And the offer to them would be that the way that's priced is that they will either do it on a lease basis so that their upfront costs are quite low, and then pay an ongoing fee so that, yes, that revenue is locked in for a long time. Very much likened to the PPA structures in the renewables world. And to the first part of your question on if we're debt or equity, so an equity only firm. I'm sorry if I didn't make that clear. So equity only is what we do. I mean, there's room for quasi equity within that, but it's an equity only opportunity. We do lever our assets, so the things we buy, we would seek to get bank debt to support that, but our capital is for equity.
Okay. Gonna take really more question, if you allow me. There is another question. What is your average ticket size you are planning for?
Yep, sure. So we don't have a hard minimum, but our preference is just for team efficiency to go for about minimum of about 10 million. So there's some plus or minus room around there. We will be capped based on the amount that our fund raises. And so you could assume between 30 and 40 million of that as a cap. So between 10, 20, 30 or 40 million is the cap. I would say though that it's becoming not just popular with us, but across LPs in general, that they have appetite for co-investment, meaning they like to come alongside specific investment opportunities, even if they're not within the fund or on top of having been in our fund. And so we can get to quite high numbers in terms of an upper limit of the ticket if there's the right opportunity that we have high conviction on.
Okay. Another question from Rashida. What have been your biggest challenge in investing in energy transition infrastructure?
Rashida, okay, cool. Is that an Africa only question? Does she specify regions?
Unfortunately, she will not be able to specify, but she just wanted to know your biggest challenge in investing.
I'm answering this as a me question, not as an AIM question, because I don't have the answer from the AIM perspective. So to me, I think the biggest challenge has just been the shift from the developed to the African markets. So prior to this, most of my experience was at Macquarie. and we looked at European markets, which have almost copy and paste structures that are applied across opportunities. The opportunity set in Africa is just a lot more nuanced per country, per region. And so the challenge, I think, is just the pace of how things gets done, because there just needs to be a bit more deliberate thought on putting the appropriate structures around it.
Yeah, another question from Part. Would you be open to financing SACCOs?
That's a very direct question. What was the name of the asker? Sorry.
What?
Who asked the question? I'm just curious. I heard someone.
Parts Sha.
Okay.
If I pronounce it well, it's Parts Sha.
Okay, thanks for that question. We've done a lot of reading on SACCOs actually to get familiar with that structure in Kenya in particular. It's not something we've been approached about, so I'd have questions as to what the opportunity is, but it wouldn't be a blanket no, is what I'd say, because I do think they lend themselves to that fleet size that we mentioned before. So questions on what the rest of the ask is, but feel free to reach out to me after and we can discuss.
Another question from Tukam. Is swapping-based model within scope, since you mentioned
Swapping?
Yeah, the swapping-based model within. Did we already?
I did, yeah. If it's not his question, then someone asked the same one.
Probably someone asked the same one. We still have many questions, and I will just take 5 more minutes to pick some other questions. So let me take the question from Vivek Mittal. Could you shed some light on the enabling environments for scaling investment in EVs in key markets? Example, with regulation, government institution need, early stage capital.
Yeah. I think the enabling environment. So there's not one answer, is what I'd say. But what we've seen work well in Kenya, which is leading, is that they have, and I mentioned this in my presentation, but I'll repeat, they have a specific charging tariff for EVs, which is cheaper to what other corporate users would use. So that's one enabling thing. I think on a going basis, EVs upfront costs have actually come down so much that there's probably an argument that the business would be sustainable even without that subsidy, but it has crowded capital in. They also have policies around VAT relief if assembly is done in country. And so to that earlier point about the capacity on the continent, if that's limiting, countries recognize that there's strength in becoming, your own powerhouse. And so the way that they are encouraging that is to tax the ICE vehicles higher and then give relief on the EVs being assembled in country. So that's worked well in Kenya as well. And I think just generally, like some of the signals, even if not strong policy, is helpful. You have the right governing body commenting on wanting to electrify its fleet. People hear that and they react to it. So that's just some of the things that have specifically worked. It's both the enabling, but also the punitive. So again, I think I quote the stat on this slide, but the subsidy removals, for instance, at the pumps in Nigeria, and you had prices coming up by 200% in 2023 in Nigeria. I think over 87% between 2020 and 24. That shock to the end user, it leaves a very immediate need for a changed solution. So it's both the pull and the pull that works well.
Okay. A question from Carl Ken. What criteria do you use to assess investability, especially regarding investment in EV ventures?
Yeah, so I'd just go back to that this screen that I talked about here, where And this is across all of the sectors, really. We're asking ourselves constantly, is this infrastructure? And it's not that we think infrastructure is the only place to make money, but that's where we know how to do it well. So let's stay true to our edge. And so are these assets big? Are they actually hard to deploy at scale? And that is why the manufacturing business is less likely to answer to yes to that than a manufacturing and a charging business. Because, for instance, the land for charging is almost a natural barrier to the other guy coming and doing the same thing if you kind of acquire the right sites. So long-lived tangible assets, predictable cash flows. What is the revenue structure against the end user? Is the end user a corporate with a large fleet? Is it an individual consumer who can choose at any time to just stop using my bike and go buy from the other guy who's coming cheaper two years down the line? And what is the downside protection? If it is that the user does stop using, what do I retain in value from the assets that I am able to enforce against? And then for us, because we are trying to grow and accelerate capital and prove business models, we don't just want something that works well now and is yielding and we run it to the ground and it ends. It's how does this business intend, how will it likely grow through time so that we can exit something that's still growing when it comes to the end of our hold period.
Okay, so two last questions before we close this meeting. Like personally speaking, I really don't want to close it because they're interesting questions and the discussion is very being insightful. Yes, I will take the question from Joseph Akubila. What's AIIM position on development stage or early stage financing for biomass-based projects in West Africa?
For which project, sorry?
What's AIIM, what's the African Infrastructure Investment Manager position on development stage or early stage financing for biomass-based projects in West Africa?
I love the cheeky ask on a sector that we're not talking about. Kudos
Yeah,
to
me
you,
too.
to
I
the
didn't.
asker.
Yeah, so I just pick it because it was actually the last question in the chat.
No, it's okay. I can answer the question. It's if you don't ask, the answer is no. So good on
Yeah.
you for asking. So if you go back to that slide in terms of this one here. Sorry, can people still see my screen? I'm sharing and I'm not sharing on my. There we go. So waste, if you see the waste to energy there, it actually should be more within. It's on the edges of because we won't do new technology. But if it's proven in terms of the technological case, it's been piloted, it works, then it is within mandate. It falls within our clean molecules vertical. And I say within as in within ATAF, not all of AIM. So that answer is an African Transition Acceleration Fund answer. Saying that we've not invested in any yet, so it is we're waiting to find the right opportunity. We're not rushing in, but it is something that we can look at. So if you do have things in your pipeline that you think is worth sharing, then please connect with me and we'll chat about it.
Perfect. So, Zoe, it was very, very insightful. And not only insightful, but the interaction. I don't know if you can see the Q&A on your side, but on my side, I have almost 50 questions, which I don't believe
Oh,
that
it's still going.
What?
As in 50 unanswered
No,
questions.
no. I mean, 50 people asked, by among which we
I see.
managed to
Okay.
ask as many as we could. And since the webinar was supposed to take 30 minutes plus 10-minute Q&A, we are at the end
Yes.
of the webinar. I really thank you for delivering this very insightful presentation. And apparently the audience really liked it. That's why we had many questions and a very great turnout. Thank you once again. Since we have seen already the interest of people with this topic, I hope maybe we will have the opportunity to have you again for another webinar.
Let's talk about that. One question can I ask this
Yeah.
team? If you can capture the questions, it'd be helpful for me to just see, especially the ones that we didn't get to, just what's on people's mind.
All
That'd be
right.
helpful.
Perfect. Thank you once again, everybody who joined. We are going to end the webinar right here.